Next, we're going to talk about the method called the first in, first out method of costing our inventory. In this method, the oldest costs become the cost of goods sold. We sell those first layers that we purchase. The more recent costs become part of our ending inventory. So generally speaking, if prices are increasing, the first in method will result in the highest net income of the other methods, other than possibly specific identification. Here's an example. We have a beginning balance of our inventory, and it shows 10 at $91. We have some purchases, and then we start selling them on August 1st. We sold August 14th, it looks like we sold 20 units. So we first take the 10 at the beginning balance of 91, and then we take the next layer at the purchase of 106. And then as you work through this exhibit, you'll see the additional purchases and then the sales on August 30th, again coming out of the oldest, the more farther away purchases, and the ending inventory results in the costs that are the most current. Sometimes it's easier just to start working on these. So the first in, first out, we're going to take a look at QS 510, and then you're going to go back to that exercise 5.3 and do number 2. You're going to then value the inventory using the FIFO method. Let's pause now, complete those activities, and come back and watch them. Refer to your textbook, page 218, for the QS54 problem. In this problem, we're asked to compute the cost of goods sold and inventory balance using the FIFO method. On January 1st, we have beginning inventory of 320 units, cost of $3. So we'll extend that out, and we get $960. On January 9th, we purchase units, and they have a cost of $3.20. Now our inventory is the 320 at 3 and the 80 at 320. On January 25th, we sell 100 units. Okay, so we're going to sell 100 units on January 25th. Oops, I'm sorry. We purchased another 100 units on January 25th, excuse me. So we purchased 100 units at $3.30. Now I have these values. I'm going to copy and paste special. And then we're going to add the 100 units and a cost of $3.34. Do our extension, and we get $334. On January 26th, we are told that we sell 350 units. So in our sales, remember, we take out of the first group first. So we're going to take all of those at the 320 units at the $3 level, extend that, and I have 30 more units that I sold because I sold a total of 350. So I sell 30 units at the $3.20 level. And I get $96. And it looks like I forgot to sum that for you, so go ahead and sum that up. And we've got 350 units sold at a cost of $1,006. So what do I have left in inventory? I don't have any of these. I sold them all. I have 80 minus 30, 50 of these at $3.20. And I have all of the 100 remaining at $334. So my ending inventory is the 150 units of only those last two, $494. Let's flip to QS 510, which we can find on page 219. Here we're going to use the same information we used in the specific ID costing, and we're going to apply FIFO costing. On December 7th, we had purchases of 10 units at $6. So our extended amount is 10 times 6. We are not given a beginning inventory here, so we assume we're just getting started. On December 14th, we purchased 20 units at a cost of $12. So our inventory balance is the 10 units we had previously at 6. And our 20 units at 12. On December 15th, we sell 15 units. Okay, so on December 15th, we sell 15 units. We're going to take out of our first group first, so we'll take 10, all 10 of those at $6. And we have 5 remaining because we sold a total of 15. So I'll take 5 out of that $20 group that's priced at $6. So what do I have left? I have none of the 10 at 6. I have 15 remaining, 20 minus 5 of the $12. On the 21st, we purchase 15 units at $14. And we have no more sales. My inventory then is the 15 from above at $12. And the 15 new purchase at $14. My total cost of goods sold, I'll sum that. And if you, it doesn't matter, it's grabbing, you could take that all the way up to the top if you want. I sold 15 units, and I'm just going to copy and paste that for $120, comma there. And my ending inventory, I just want to add those two numbers. I've got 30 units at $390. In summary, I sold 15 units that have a cost of $120 total. That will go to my income statement as cost of goods sold. I have remaining in inventory 30 units that I will report on my balance sheet for a value of $390. Now let's go to exercise 5.3. We'll return to that one, and this time we're going to value the inventory using the FIFO method. Again, we'll look up So you'll see that I'll have the specific ID. Oh, so my purchase, our beginning inventory is 140 at $6. So we'll go ahead and put that in, 140 at $6. My amount is $840. What happened on January 10th? We sold some goods. So I sold 100. I only have the one layer, so I know that. So $6, and we'll extend that. On the we purchased 60 units at $5. And I guess I forgot to bring my inventory balance down the previous. So we had 140, we sold 100, we had 40 remaining at 6, and that will carry down to our next group as well. So we'll have the 46. And then we have the new purchase at 5. On the 25th, what happens? On the 25th, we sell 80 units. Okay, on the 25th, we sell 80 units. So we only have 40 remaining at the $6. So we'll get rid of those first. And then we'll take 40 sales out of the $5 group. I have none of this group remaining. I sold them all. I have 20 units of the $5 group remaining. 60 minus 40. On the 30th, we purchased 180 units at $450. So my ending inventory is the 20 units at $5, and the 180 units at $4. In summary, then, under the FIFO method, I sold 180 units at $1,040. In my inventory, I have 200 units at a cost of $910. Notice in this case, this is sort of an odd one. Our prices are going down. Normally we see prices increasing. In a prices rising or prices declining situation, the ending inventory will have a lower value and the cost of goods sold will be the greater value. That concludes lesson 3, I believe we're on.